So we have talked about different situations of account receivable and how to account for those. Now let's do a brief summary. We have account receivable. And we have talked about the situation of how to account for trade discount and cash discount. How to account for sales return and how to account for uncollectibles. For cash discount, we talked about there are two methods, the gross method and the net method. And for uncollectibles, so the journal entry is to debit bad debt expense, credit allowance for uncollectible account. And how to determine the amount for bad debt expense? There are two methods. One is called income statement approach. The other is called balance sheet approach. And the account, the specific accounts we covered, which regarding account receivable. So we covered several accounts here as well. On the balance sheet, we have account receivable. So we talked about allowance for sales return. So this is a contra account to account receivable. We also talked about allowance for unconnectable account. This is also a contra account to account receivable. And the account receivable minus allowance for sales return minus allowance for uncollectible account, that will give you your net account receivable. So this is on the balance sheet. On the income statement, we start from sales revenue. And sales discount. This is a contra account to sales revenue. Sales discount forfeited. This will add up, this will increase your sales revenue. And then sales returns. So this is also a contra account to sales revenue. And your sales revenue minus sales discount plus sales discount forfeited minus sales return, that will give you your net sales revenue. And after that, bad debt expense is an expense account. So specifically, under the gross method is related to your sales discount. So yeah, those are two related. Sales discount, we record sales discount when the firm used the gross method. And if the firm used the net method, we may or may not record the sales discount forfeited. This is a related account. And if the firm has sales return, we need to record allowance for sales return and sales return. Those are two accounts which is related to sales return. For uncollectibles, the related account is allowance for uncollectible account and the bad debt expense. So those are related accounts we covered in today's class. And then the other thing I want to talk about is I want to talk about allowance for uncollectible accounts, this account. And so this account, it is a contra account to account receivable. And specifically, let's look at how different events is going to change the balance of this account. So we start from a beginning balance. And this beginning balance is carried over from the previous financial reporting period. And the ending balance for this account, if the firm is using the balance sheet approach, we need to estimate this ending balance as a percentage of the firm's account receivable balance. However, how does the this account change during the financial reporting period? So first of all, it will be increased by the recording of bad debt expense. So if the firm recorded any new estimation of the bad debt expense during this period, this account will increase due to the general entry of debit bad debt expense, credit allowance for uncollectible account. So this is the general entry which will increase this account. And it is also going to be affected by the write-off, the written off of the uncollectibles. So if the firm confirm that there will be some uncollectible during the period that is actually happening, the firm needs to write off those account receivable. The general entry is to debit allowance for uncollectible account, credit account receivable. And this general entry will decrease this account, the account of allowance for uncollectible account. And the third situation that will affect the balance of this account, we haven't really mentioned in today's class, but I want to mention it here is, so in some situation, sometimes firm may have written off some of the account, but later those accounts turned out to be collected. So in those situations, we need to reinstate those. And then the journal entry is just to reverse this journal entry to debit account receivable to credit allowance for uncollectible account. And then the firm just need to debit cash credit account receivable. This is what the firm needs to do when some of the account receivable it has written off turned out to be collected again. So the firm needs to reinstate those balance, and then it will increase allowance for uncollectible account balance again. So and under the income, so we just talked about the balance sheet approach. If the firm is using the income statement approach, instead of estimating the balance, the ending balance for allowance for uncollectible account, we need to estimate bad debt expense directly as a percentage of the firm's credit sale.